Hi, this is a video about how to use the Form 3115 to apply a cost segregation study to a rental property that has already been using a different depreciation method. So basically, the situation is you have a rental property and you had a cost segregation study done, which is a way to take more of the depreciation earlier than just the traditional method of just depreciating a property over 27 and a half years or 39 years. So if you do a cost segregation study, it breaks it out into these components, some of which can be depreciated faster. And so it's basically a way to get this nice tax advantage earlier than you would with normal depreciation. So if you had a cost segregation study done, and you're applying it in the same year that you first are placing the rental property in service as a rental. So, in other words, if this is a new rental property that you haven't yet filed a tax return for because it's the first year you've been renting it out, then applying a cost segregation study is relatively easy. You just set up the depreciation using the information from the cost segregation study. But things do get more complicated if you have already filed some tax returns using the original depreciation method, and now you want to apply a cost segregation study. If you have filed just one tax return using the original depreciation method for the rental property, then you have a choice. You can, at that point, still amend that one previous tax return to apply a cost segregation study. And so the way that works is it would be applied to that previous year tax return. And so it would be applied to the income that you got that year, and you could amend that past year return and presumably get a tax refund based on applying the cost segregation study. In that situation where you've had just 1 year of just one tax return that has used the old method, you have that choice, or your other choice is to instead use Form 3115 to do this change in accounting method to apply the cost segregation study in the current year, so it applies retroactively. So you get the tax difference that you would have received if you had used it from the start, but it all applies to your income in the current year. So a scenario where you would want to do that instead of amending the previous year return is if your current year income is higher, if you're in a higher tax bracket, then there's an advantage to applying it in the current year. Otherwise, if it's been just 1 year, you have this choice. And for different reasons, you may want to choose either this 3115 method or amending the previous year return. Now, if you have filed more than one return since the rental was placed in service, so if you filed more than one return with the original depreciation method, you don't have a choice. You can't go back and amend more than one tax return to apply a change in depreciation. You have to use the Form 3115 to apply. Let me go to that form. So this is the 3115 form. You have to use this form to apply this change in accounting method to be able to apply the cost segregation study to retroactively go back and say, okay, now we're using this new depreciation method, and you have to apply it to all of the past years that it's been a rental. And so using this form is how you do that. Only some consumer tax software has a way to fill out the 3115 in the software. TurboTax Online doesn't have a way to do it, but TurboTax Desktop does have a way to fill out the 3115, but only if you go to Forms mode. Then you could search for the 3115 and fill it out that way. Some other software like TaxAct has it built in where you can fill it out with that. If you go to the miscellaneous forms in TaxAct and look for 3115, you can find it there to fill it out. The problem with TurboTax Desktop is you can fill out the form, but it doesn't let you attach any attached statements or other attachments that you need for it, like the depreciation schedule. So you can't actually file it that way. It's not going to work because you can't file these attachments. So the way you'll want to do it with this type of software, whether you're doing TurboTax online or desktop, is you'll fill out the 3115 and the attachments, and then you'll send it separately from your tax return. So you can still e-file your tax return, and then you'll have to get a Form 8453, which lets you later paper file an additional form, including the Form 3115. This is the 3115 form. You can download it from the IRS website if you search for it there. If you want this copy that already has the fields filled in for applying a cost seg study in this example that I'm showing, you can download that from my website, and I'll put the link for that. And then to edit it, you can edit it in whatever PDF viewer you have. I'm doing it in the Chrome browser because it has built-in abilities to let you fill in forms. So the Chrome browser works fine, so I'm just doing it in that. You may also want to go to the IRS website and download the instructions for Form 3115. If you end up with any questions that I didn't cover in this video about what some of the fields mean, most of them are covered in the instructions, so that might be helpful for you. Okay, so taking a look at the form, I've already filled this out, but we're going to go through it and talk about which fields you need to fill out. So we start with your name here, your identification number, which is your social security number. This has the address, which is, so your address there. Okay, so for the tax year, this is going to be, it doesn't matter how long the rental property has been in service or how far back this change is applying. This is just going to be the current tax year that you're applying this change to. So in this case, it's 2025. So we're doing from 1/1/2025 to 12/31/2025. So just the whole year. This contact info, generally, it's just going to be you if you're filling this out. And so it's the same. So you don't need to put anything there. You can, if you want, add your telephone number here. So you can add that if you'd like. This question about whether you want to receive a copy of the change in accounting method, I would just say no here. You probably don't need that. For the type of entity here, you're just going to be an individual. You wouldn't want to have a rental property in a corporation. If it's a partnership, that's outside the scope of what we're covering in this video. So in this case, it would just be individual. Even if you do have it within an LLC, if it's a single member LLC, you would still be considered an individual for purposes of this form. Okay, so moving down here, this is an important part. The DCN code for when you apply a cost segregation study is going to be 7. So we put a 7 in this field. So in this case, these questions just have to do with this type of change. This type of change, the answer to question number 2 is going to be no. Has the filer provided all of the information statements required? We're just going to say yes for number 3. For question 4, in the tax year of the change, did or will the applicant cease this business? This should be no. Generally, you wouldn't be applying a cost segregation study in the year that you're ceasing the rental business, so that's going to be no. Do the regulations apply to these code sections? The answer for this type of change is no. Okay, so moving on to the next page. Okay, so for question 6A, this will depend on your situation. So this is, does the applicant have any federal returns under examination? If you're currently being audited, you might have a different answer for that, but otherwise it would be no. Coming down here, does audit protection apply to the applicant's requested change in accounting? The answer is yes for this type of change that we're doing. So for 7B, you would choose what applies to you in this situation. Usually it's going to be not under exam. And so we selected that option. Let's see, for 8A, does the applicant have any federal returns before appeals or federal court? Usually that's going to be a no, so we selected no for that question. Has the applicant or predecessor related party made a change in accounting method within any of the past 5 years? So this is something that's good to know about, is that this type of change you can only apply once every 5 years. Normally when you get a cost segregation study, it's just a one-time thing, so you wouldn't be applying other changes. That is something to be aware of. So we're choosing the no in this situation. And for the next question, does the applicant, so do you have a pending private letter ruling? That's usually going to be no, that's pretty rare. That would be something that you had requested with the IRS. Is the applicant requesting a change in its overall accounting method? The answer to that is no, we're not changing the cash basis accounting method, so it's going to remain the same. We're just changing depreciation, so that's a no. All right, going to the next page. Okay, so question 18, does the applicant request a conference with the IRS if they have an adverse response? If they decline it, we're just saying yes, it just gives you more options. And that's it for this page that we need to complete. Okay, so for this next page, so the first question, 25, no for this type of change. Okay, so question 26, the important part of this is we have this amount here. Calculating that is part of the process, and that's something that we'll talk about later in this video, but this would be the overall change in your taxable income because of applying the cost segregation study. So this includes the change in your taxable income going back to the whole time that you've had the rental property for this entire change in accounting method, you have to see how it would apply retroactively to change your amount of depreciation during that time. We're going to talk about how you calculate that separately, but this is where you put that amount. It is important to note that when you're applying a cost segregation study, generally what it's going to be doing is reducing your taxable income because it's giving you more depreciation. So this 481A adjustment, this change in your amount of taxable income, is going to be a negative number in that case. It's important that you remember to enter this as a negative number. So be sure that you do that when you get to this step. Okay, so for the next question, 27, is the applicant required to take into account the year of change, any remaining portion of Section 481A adjustment from a prior change? That's going to be no in this kind of situation. 29, this asks about an affiliated group. This wouldn't apply. This is something that has to do with corporations and ownership, and that wouldn't apply to the situation, so we say no for 29. Going through the rest of the pages here. So we're skipping some of these things. Most of these are things that just don't apply to this type of accounting change. And we're skipping that page. Okay, so when we get to Schedule E on this page, this is when this is a type of change that's applying to the situation. So we have to answer these questions here. For this first one about these regulations, it's just no for this type of change. Is depreciation or amortization required to be capitalized? We can say no in this case. Have these elections been made? These would generally be no, so we're saying no for this situation. Okay, so question 4B here. This depends on your scenario, so it's asking if the applicant lived in the property before renting it. You can just put whatever choice is correct for your situation. So that could be yes or no. Is it a public utility property? That's going to be no. That's not what we're doing with this type of rental property. Okay, so that's the end of the form. So that's the end of what we need to put on the actual form, but there are a number of attached statements and other attachments that we need to add to it. And that's when it gets a little bit more complicated. We'll take a look at that next. Okay, so next we're going to talk about the attachments that you have to add to the Form 3115 in order to provide some more statements that are required for the type of accounting method change that we're doing. I want to explain that a lot of the information as far as what we know to put in these attachments comes from this, which is Revenue Procedure Document 2022-14. This is about a 500-page document that the IRS puts out and updates occasionally, and this is the latest update. This has information on the change in accounting methods, changes that you can make, and how to make those changes. So that's the source of the instructions that we're using to come up with which parts of the Form 3115 that we filled out, but also what statements we need to attach to it. This is a document that you can get a copy of this as part of the package that I offer on my website. So you can go to the website and take a look at that if you'd rather download it from there rather than creating this yourself. In this case, according to that revenue procedure document, this is the type of information that we need to provide for. This is for part 2, line 14. So this is just an answer to one of the questions that's on the 3115. By the way, this whole document, this statement, what you would do is you would edit it to apply to your situation, and then you would attach it as either a PDF if you're e-filing it, if you're able to do that, or you would be just printing this and including this with your tax return when you file it. So if we go through this, this is just some pretty standard language that explains the type of change we're making. These parts that are highlighted in yellow are things that you would have to change to apply to your particular situation. So the first one that comes up here is whether you are leasing non-residential or residential real estate. Under this section of the tax code, the way that's defined is it is residential if you have an average stay for the year of 30 days or more, then it's a long-term rental. And if it's residential real estate, assuming it's that and it's long-term, then it's residential. If you're doing short-term, and in this case, the definition is if it's less than 30 days, or if it's just non-residential property, if it's not residential. In either case, if it's short-term or non-residential, the tax code for this situation considers it to be non-residential real estate. So if that was the case, then we would be choosing this part of it, and we would just leave it like that for this statement. Down here, we have the tax year of the change. This is the tax year that the change is beginning, but this is basically the year that we're applying it. And I think for this example, we're doing 2025, so I'll change it to that. So these are other answers to different parts of this line 14 question. It asks for the present method, and we have a statement describing that. It asks for the proposed method, and this is where we explain that we're applying a cost segregation study. This highlighted part in yellow is something that may apply to your situation, but I have it in here because it's pretty common. So what's going on here is if you have a rental property that's short term, so this is under that definition where it's less than 30 days, the depreciation method you have to use for the structure itself isn't the regular 27 and a half years that people generally use for a rental property. When it's short term, when it's under that 30 days, you actually have to depreciate the structure over 39 years instead of 27 and a half. So that's unfortunately not to your advantage. You'd rather depreciate it faster, but to do it correctly, that's the correct method. And so if you're getting to this video and you're doing this cost segregation study, and you're now realizing at the same time that you've been depreciating the structure over 27 and a half years, at the same time you apply the cost segregation study, you're going to want to make this change to also correct the depreciation period of time to be 39 years if it's a short-term rental. This can vary from year to year. So if in the current year it's a short-term rental, then it's going to be 39 years. But if in the next year it becomes a long-term rental, then it may go back to 27 and a half years, and you can just change the type of depreciation just that year. You don't have to file another form to do that or anything. It can just change from year to year. But if you're watching this and you're realizing now that you had a short-term rental and it should have been 39 years for that entire time, this is a statement that you can make. And so you can apply this change at the same time you're applying the cost segregation study. So that's what the purpose of this statement is. The present method is going to be cash. Pretty much everyone is going to be cash, not accrual for rental properties. Then what we have here are just other answers, other statements for some of the other questions. The description of the trade or business is just rental real estate. There's this question about the legal basis, and so these are just standard statements that we can apply, explaining why we're able to apply a cost seg study. Some of these other questions we're referring them to a depreciation schedules attachment, which is going to be another statement that we're going to make separately, and we'll get to that also later in this video. So some of these are just saying refer to that attachment. This is saying what code sections apply, so this is going to be just pretty standard stuff here. And that's pretty much it. So those are these other answers that you'll need to attach using this type of statement. And then we'll move on to the next step. Okay, so the next thing we're going to talk about is this is a spreadsheet that has the differences between the original depreciation method and the new depreciation schedule. So this is going to be one of the things that we'll attach to the Form 3115 that we send to the IRS to show the changes that we made. This is just in a spreadsheet. I'm using LibreCalc, which is part of the LibreOffice, the free alternative to Microsoft Office. But if you have Excel, you could also use that. I do include a copy of the spreadsheet in the package that you can download from my website, and I have it in both formats. So if you're using Excel, you could just do this in Excel, and that works also. Okay, so starting from the top here, we have some information about the property. This is a drop-down where you can choose either short-term or long-term property. This again is based on whether the average stay is more or less than 30 days. So it becomes what's considered for this part of the tax code non-residential if it's a short-term rental. And so we can choose whichever option applies in this case up here. And then we just have the address, and then we have the year it was placed in service. This is the first year it was rented out. So this would be the first year that you file the tax return with income and expenses for the property. The current tax year is here. Based on that year that it was placed in service, this is the amount of bonus depreciation that applies in that year. So we're going to use this amount for calculations later in the spreadsheet. So if you want to see how much bonus depreciation applies in the current year, this is from an article that's on my website that has information about that. You can also find it other places online. But basically in 2023, we had 80% bonus depreciation. So that's the amount that we put here. And this next line is just the type of activity, which changes based on what we select here, if it's either long-term or short-term. Okay, so moving down here, so this is showing the original depreciation schedule. So this is how we had been depreciating it. We have the place in service date. We have the life, which in this case, that's 27 and a half. You might have been doing 39. If so, it would be that. This is the prior depreciation amount. This amount we can just get from the previous year tax return. So this isn't including the current tax year. This would just be, all this is just about the past years, not including the current tax year, because that's what we're adjusting with the 3115. So for this, we would be looking at the past year tax return and the accumulated depreciation up to that past year. And so that's what we put here. We have the improvements and we have the land. The improvements is everything except for the land. And then we have the amount of the land, which isn't depreciated. So that top part is just based on how we had been doing it in the past years. So this bottom part, the proposed depreciation schedule, is the new schedule based on the cost segregation study. So the structure part, the 27.5 years, or it could be 39 years, this amount goes down. So the basis is a smaller amount because we've divided it up with the cost segregation studies. So note that the total basis is the same and the land also remains the same, but we basically just divided up the cost basis of the improvements using the cost segregation study into the structure part, but then also 15, 7, and 5 years. In some cases, you may have some 7-year property, but that's less common. It tends to be mostly the 15 and 5 years that breaks out with the cost segregation study. So this spreadsheet will actually calculate the new prior depreciation for you. So as long as you have the correct placed in service date, you have the correct bonus depreciation amount, then the basis you put in here, it will calculate that prior year bonus and also the total depreciation. And then so it adds it up and it gives us the total prior depreciation. So now the difference between this new proposed depreciation schedule and the original one is shown in this calculation here. This is how we get what it calls the 481A adjustment, which is the difference between these two types of depreciation before and after applying the cost segregation study. And so this 481A adjustment amount is what we end up putting on the form 3115 back in that box where we use that value, which is in this part 4, question 26. So that's where we put this value, which we calculate on this spreadsheet. So this spreadsheet, in order to attach it to the tax return, what we'll end up doing is export it as a PDF, and that prints out, that produces a nice kind of clean version of it that we can submit to the IRS with the form 3115. Okay, so now that we've completed that spreadsheet, the next step is to enter the new depreciation information into your tax software. Exactly how you enter that will vary depending on the type of software that you're using, but essentially the result that you'll want to get is this, which is you'll be either modifying or removing the original asset for the original building and using the new information from the cost seg study results. So looking at the spreadsheet, we're going to look for the main part of the property, which is either going to be 27.5 years or 39 years if it's short term. You're going to enter the new basis for that. So it's still going to have the same place and service date, but it's going to have this new basis amount. So over here on this depreciation schedule, you can see that new amount there. And then we're going to add new assets for the other parts that the cost seg study divided up from the original structure. So in this case, we have 15-year property. So we are adding a new asset with that basis amount. As you add these, the other important thing to do is to make sure that you also enter the correct prior depreciation amount. So your tax software should have a place where you can put in the existing prior depreciation amount. And so that's going to be the amount that you see in the spreadsheet here. So for that first one, we have this amount. For the next one, we have this amount for the prior depreciation. So that's the prior depreciation before this tax year. And it does change when we apply the cost seg study because the cost seg study is going back and saying this is what it would have been if we had been using this cost seg study depreciation from the beginning. The other thing you're going to want to make sure is correct when you enter these assets is that it's using the correct lifetime. So for the 15-year property, that should be 15 years, and you should see that on your depreciation schedule. In this case, we don't have 7-year property, so we'll skip to the 5-year one. And so we entered the 5-year property here with the correct basis, the prior depreciation. And so we see all those amounts here for the 5-year property. So essentially that's what you're going to want to see is make sure that your depreciation schedule that is produced from your tax software matches what you're seeing on the spreadsheet. The next step is to add the 481A adjustment amount to your tax return. So this amount is the difference between the depreciation that you did take and the adjusted depreciation after applying the cost seg study. This is the difference that's a tax benefit that you get because of this additional depreciation that you should have been able to claim if you had been using the cost seg study from the beginning. So the way you add that to your tax return is this adjustment is a negative amount. So that means that it's negative income for you. So that's reducing your taxable income. And so it's a benefit for you. The way we enter that is as a rental expense. So in your tax software, wherever you can enter expenses, you're going to add a type of other expense. And you can give it the name 481A adjustment. And then you enter this amount. When you enter it as an expense, don't enter a negative number. This will be a positive amount because it's an expense, which makes it negative. So we're just entering a positive amount. And on your Schedule E, that should show up on as part of the amounts that you have in this line 19 for the other expenses. And that's where you should see it. Okay, and then the last step is to actually file the 3115 form. So you actually have to send two copies of it. So one will be included with your tax return, and then additionally, you also have to mail a copy of it to the IRS. They want this additional copy of it. If you look at the instructions for Form 3115, there's this section where it tells you what address to mail it to. So take a look at that and see what address to send it to. In both cases, when you file it with your tax return and when you mail this copy of it, you'll need to include either the PDF or the printed version of the spreadsheet that we created with the change in the depreciation schedules. And also the attached statements that we have in this word processing files, you'll need to send them that. When you file the copy of the form with your tax return, you don't need to separately sign the 3115 form. Your signature in the tax return is sufficient. But the copy that you mail to the IRS separately, you do need to sign that one. The way you'll do that is you sign at the bottom here. If you're filing jointly with a spouse, then both spouses should sign on this line, just sign right next to each other there. And both your name and the spouse's name should also appear there. And then also remember that if your tax software can't file the Form 3115 with the attachments, then instead of filing it with your tax return, you'll want to file your tax return first. And then just after that, you'll need to print and mail in this Form 8453 that you can find on the IRS website. And you want to complete this. It has an option for Form 3115. And so you'll print this along with printing the Form 3115 and the attached statements and also the depreciation schedule. And you'll want to make sure everything is signed and mail that in. I hope that information was helpful. For more information and to download the spreadsheet and other files shown in this video, please go to taxmodern.com/3115. Thank you.